Vitale, American Retirement Advisors with the Grading Investments weekly talking points for the weekend on September 30th, 2023. Welcome to October. We've got beautiful weather for the time being, so let's enjoy it. But let's get into stocks, which we're not enjoying right now. Stocks were mixed last week with the investors anticipated important economic data for the month, with the S&P 500 going down 0.71%. Russell was up 0.55, but the NASDAQ was also up 0.7. Now, overseas, the developed markets, which is the EFA, was down 1.4, and the emerging markets was down 1.13%. In the U.S., the best performing sectors were energy and materials, while utilities and staples were the laggards. Now, by style, small caps were the best performers, and growth stocks outperformed value stocks. We've seen it a lot this year, but it's going back and forth, and we're actually having pullbacks now. Going to fixed income, interest rates rose and bond values declined, with the benchmark 10-year Treasury ending the week at 4.59%, having reached its highest since 2007 on Wednesday. It's actually up even more this week. The differential or spread between the 2-year and the 10-year government bonds has shrunk from a low of 1.07% in early March to 0.44% at month end. So we're starting to see that happening even more now. We're seeing higher interest rates going up as well. Let's get into commodities. Oil prices climbed to the highest level in over a year on Wednesday, reaching $94.75 per barrel for West Texas crude, due to ongoing supply curtailments from Russia and Saudi Arabia, and prices settled back to close to the week at $90.79 for a weekly gain of 0.84%. How about economic data? Consumer sentiment dropped to 68.1 at the high end of the consensus range of estimates, and down 1.4 points from the August report. The report reflected consumers' concern about possible government shutdown and the impact of the auto workers strike. And of course, doesn't help, it's all hitting the market, so we're starting to see that happen. Inflation, as measured by the Personal Consumption Expenditures Index, which is a PCE, was 0.4% on a month-over-month basis in August, on the low end of the consensus expectations. However, it edged up from 0.2% in July after excluding volatile food and energy. The core PCE rose just 0.1% month over month, which is below the expectations of 0.2. Well, there you have it. But really, we're starting to see it's tightening. We're seeing tightening right now. How about let's go to company news. Advanced Micro Devices Inc., AMD, and NVIDIA, both Core Select and G33 holdings, rose 6.88% and 4.5% respectively last week, as most semiconductor stocks moved higher after intense selling over the past several sessions. This rebound occurred despite cautious guidance from industry stalwart Micron Technologies, since investors believe their issues are contained to that one firm. So we're starting to see, of course, those are all very much intense with involved in AI, which is huge right now. How about ARA Energy, which is a Core Select and G50 holding, declined 15.38% last week. The ARA Limited Partnerships net announced that its earnings growth outlook is greatly reduced due to rising cost of capital. Gradient is currently reviewing the NEE holding, and we'll see how that goes. And that's it for this week's market summary. Thank you so much for being part of our ARA family. If you'd like to get a hold of us, you know the number, 855-756-5700. Visit us online, YouTube, Facebook, our website, aradvisorsinc.com. Feel free to reach out with any questions. We're going to keep in touch. I know we're starting to see the markets also down this week. A big sell-off today. So it's up and down, and it's very turbulent, very volatile, which is why we've got so much in diversification, which we always say, have some guaranteed, have some safe money. That way we can play, we don't have to worry about the market going up and down. We still hate to see it, but we know that we've got income secure and money that's safe, so we can weather the storm. The biggest thing too, in the last 2 years, a lot of our accounts aren't even. Some of them are higher, we got the guaranteed money, so we're still going along. But you got to look at what happened in 2021, which was a great year, 2022, which was a horrible year, and 2023 rebounded strong, but still didn't make up a lot of the losses from that. So we got 2 lost years there. But again, as long as we have good safe rates of return right now, we're seeing over 5%. So it's good to have some good rates right now. Now's the time if you've got a lot of our clients, a lot of you have some older annuities. We're trying to help you with this, make sure it's like a refinance type of a thing, to look at ways to get better rates of return, that we can get better rates, better safety, better growth, and take the opportunity while it lasts. So we'll be in touch. If you need to get a hold of us, you know how to. So God bless you. We'll see you again next week.